Good afternoon and welcome to HYCM's webinar FX Week Ahead Live Market Analysis with myself, Giles Coughlin. We're going to be together for the next half an hour while we look at some of the significant events that are coming up this week. It's a very busy week. There's a lot of different activities happening. There's a lot of different events that are unfolding. So just to be aware that it's quite an exciting and busy week. Before we get into it, please can you make sure that you can hear me? So if you could just let me know that you're hearing me. Hi Nadir, thanks for the welcome back. It's good to be back. That's super. And just checking. Oh, hang on. Now, there we go. The main screen is showing. I've made that mistake once before. Thankfully, that's all okay. I'm assuming you can hear me okay, and now you can see me. Apologise for that slight delay. I've always got to make sure I've got to put a show main screen before I start speaking. But we're okay. We're all set for today. Don't forget, as we go through, to ask questions or make comments. Always really appreciated. I will be in the next webinar. I'll be giving my direct email address, just getting that set up. That'll be within the next few days, and then you can email me directly, and I can look at any ideas, particularly for the workshop on the Tuesday that we run. For now, just making it clear that as we go through. Hey Raj, good to see, good to have you. It was good to spend time with you last week. For those of you who are just joining this webinar, we had a week I had a week in Dubai last week, and we did a seminar and a workshop and a VIP day for traders, and those 3 sessions went really well, and it was really good to meet all the guys that were there. And obviously Raj was one of the main guys there with a number of his friends. Good to see you, Raj. Just to make it clear that the disclaimer was any sort of trade setups we look at today, they're not trading advice. The idea is not that I provide signals. The whole idea of what HYCM is trying to do with these workshops and these seminars is to provide education for traders. So the idea is that traders educate themselves so they can start making their own decisions in trading. So as we're going through different setups, so we'll be looking at different technical areas, different places that you can enter, exit the market. There's not trading advice, it's just education, trying to show people sensible places to enter, sensible places to exit, and how to go about making those trading decisions. So it's the old saying, isn't it? You give a man a fish, you feed him for a day, you teach him how to fish, you feed him for a lifetime. So this is the whole idea. It's education, so you begin to grow in confidence to make your own trades. Now, this is the live market analysis we've got coming up for this week, 25th of Feb through to the 1st of March. And there is a tremendous amount of things going on. It's just so busy in the markets at the moment, and a number of these events could have really big impacts in the market. So really got to pay attention to this week. But the good news is, if you're on this live market analysis now with me, you're not going to get caught out by the huge moves that could happen in this week. So just before we look forward, we always look back, and just looking back, we can see last week that the Australia Central Bank has moved to a more neutral phase. So continue to expect medium-term pressure on the Australian dollar. Now, the complications with this is the US-China trade war that's going on simultaneously. Now, anytime there's looks like that trade war is going to be resolved, is going to result in Australian dollar strength. So you've got to be aware of those two twin pressures on the Australian dollar at the moment. Pressure one, bearish, is that the central bank has moved to a more neutral phase after for a long time saying that rates are going to be staying as they are, but the next hike is most likely to be up. Now the central bank is saying that risks are more balanced. It could go either way. So that is the shift between the Australia Central Bank. So expect medium-term pressure on the Australian dollar, but also be aware that if the US-China trade war situation gets relieved, we're going to see Australian dollar strength. So when I was trading the Australian dollar, I was trading it against another commodity currency, which is the New Zealand dollar, to try to mitigate against that risk. There was some talk last week of China boycotting Australia's coal imports. Now that is serious potentially for Australia, because if Australia fall out with China, Australia's economy could be hit quite badly. That's because Australia's economy, about 30% of its GDP comes from its trade with China. So that was particularly significant last week. China sort of denied it, and they said, no, we were just checking the quality of the imports. But either way, if you're checking the quality or if you're boycotting the imports, either way, less coal's getting through. Now, there is some tension between China and Australia, and it's this Huawei issue that pops up across the world. And Huawei is kind of like a center point for the problem that the world has with China, certainly the developed nation. And it's kind of, you know, a lot of it's been played out with how folks are reacting to Huawei. And Australia last year denied Huawei some access to its network, its own mobile phone networks. And that was, you know, a blow to China. And that was, you know, that created tension between the two countries. So hence this China's boycotting coal imports could be seen as a hit back from this Huawei issue. So that's just one to be aware of, one to watch. Look out for that, and look out, remember, if there is relief between the US and China trade war, we will cover it in more detail in a minute, then we're going to see the Australian dollar bid on that relief. So just be aware, twin pressures on the Australian dollar at the moment. Got to hold them both in balance. This was the revised forecast growth and inflation, and the whole question last week was, is this, there was quite a lot of data coming out for the RBA, and the question is would this neutral phase remain for the Reserve Bank of Australia? And it has. It's remained throughout the week, and it sort of culminated with Westpac last week. They forecast the next move for the Reserve Bank of Australia to be a rate cut. Okay, so they revised their GDP growth forecasts from 2.6% to 2.2%. So you can see here that was, if you look, that this is Westpac's growth forecast. This was the Reserve Bank of Australia's forecast, and you can see that Westpac are a lot more pessimistic than the Reserve Bank of Australia. The Reserve Bank of Australia got their 2020 growth forecast at 2.75%. Westpac saying they're going down from 2.6 to 2.2%. So you can see that's a considerable divergence from the banks. And Westpac is one of the largest banks in Australia. So that's you know, that's significant for them to predict a Reserve Bank of Australia rate cut. And they are saying that there's a strong case now for official rate cuts to cushion the downturn. So that is an issue I want to be aware of. It's one of the largest banks in Australia, so they obviously will have access to their own lending book, and they can see the pressure that's on their own customers and the clients within Australia. So that's just to be aware of that more pressure. You know, that macroeconomics, the bigger picture is pressure on the Australian dollar. But bear it in mind, we've got the US-China trade war playing out, so it could confuse trading the Australian dollar, particularly against something like the US dollar. There was also some news last week that the Reserve Bank of New Zealand is planning to hike capital requirements for banks over time. Now, this was quite interesting because they said if they do it, it might result in marginal tightening in financial conditions and may result in an eventual rate cut. Now, obviously, the idea of a rate cut would be very bearish for the New Zealand dollar if the central bank is suddenly saying that. And at first reaction was a strong sell-off of the New Zealand dollar. But then when it became clear, look, these hike proposals would phase in over 5 years for big banks, and for smaller banks over 7 years. So that's quite a long run in, and it's not really immediately market moving, saying this is something that's going to go in over 5 years. So that's a long way down the line. But something to be aware of, it's in the background. And the New Zealand dollar was was sold on that headline, but then as traders got into the detail of it, they saw this is not, this isn't as immediate as the headline makes it seem. However, be aware of it. I was short Australian dollar, New Zealand dollar when this headline came out, but I held my position because of the fact that it was 5 years of banks and smaller banks were 7 years. So I thought, well, that's not really going to alter that Australian New Zealand dollar short position that I was in. Next was, this was interesting. This was Trump threatening tariffs on EU vehicle imports to the US. Now, there was stats coming out of Germany today saying that, motor vehicles were the country's most important exports last year. Look here. So the main German trading goods, it's motor vehicles, trailers and semi-trailers. It's a value of 230 billion euros. That's the export market for German trading goods. And the US is the country's biggest market, and automotive trading going to the US is a surplus of around $22 billion. Okay, so one of the big things that Trump's been threatening is going to put 25% tariffs on vehicles imported to the US on Europe. And so this is becoming like, oh, great, if you can hurt Germany, you hurt the whole Eurozone. So Trump is seeing that this is a great negotiating card for him. He can threaten tariffs on EU imports of cars to the US. And, if you look at the data that came out of Germany, basically Germany imported about 5.2 billion in autos and parts from the US, where the US import about 27.2 billion worth of equivalent goods from Germany. So in other words, the US are purchasing 27+ billion worth of goods, and the EU are only importing 5.2 billion in autos from the US. So that's a trade surplus of 22 billion euros to the European side. So if Trump has his way, Germany could lose about 50% of exports to the US in the long run. So that's roughly equates to 17 billion euros. So if the EU and the US can come to an agreement over managing the trade surplus and trade here, good. Otherwise, there's the potential threats of tariffs. And if there's tariffs, the German economy is going to take a greater hit. And if Germany's hit, Europe's hit, because Germany is the largest country within the Eurozone. So that's just a story to flag you up on. And remember, the political side of it is Donald Trump can use that anytime he wants to try and negotiate with Europe. So, have that in the back of your mind, and it's very significant for the euro US dollar pair and risk generally. US-China trade walks, these are big, and obviously I've explained this a number of times. We will go over it briefly, why that's so big. But the deadline is the March 1st, and that ends the truce that there's been between US and China. And if no deal's arranged by then, markets hope the deadline will be postponed. Okay, so the alternative is that there's a trade war escalation, and Washington will place 25% tariffs on $200 billion worth of Chinese goods. That's basically double current levels. So in other words, if no deal's arranged, if there's no extension of this truce, then there will be an absolutely enormous escalation of this trade war. And Warren Buffett was out on Reuters just a few minutes before this webinar started. He was saying that it's going to, it's really going to affect world markets. He was saying that it's going to have a significant impact on the world economy. And obviously Donald Trump really cares about the Standard & Poor's 500. And if this trade war, becomes really heavy and serious, which it would do with this 25% tariffs, then the S&P 500 would fall rapidly. Okay, and Donald Trump doesn't like this S&P 500 falling rapidly, so it's his interest to arrange a deal. Okay, there's been some more positive sentiment coming out of the market this morning that a deal's going to be done, but there's no detail on that deal that I've seen come yet. So that is the situation that's going on there. Just to remind ourselves, we've got the slowdown in China's growth. You can see The sales falling, particularly automobile sales falling out of China, and we've also got petroleum-related sales and clothing, catering, and retail sales all sort of on a general downtrend if you take it from December 17 here to the end of 2018. That slowdown is carrying on. We've also got a slowdown in manufacturing, a real sort of dive here in the Kangxin Purchasing Managers Index. So that's a slowdown there. And there's concern, you know, China accounts for a fifth of global manufacturing, okay? So the trade war disrupts the supply chains, hiring, investment, and so the concern is that the knock-on effect, and you can start to see some of that knock-on effect is being seen across Asia. So here you've got the Japanese Advanced Purchasing Managing Index. You can see that that's taken a dive down here, so underneath 50, and the concern is that the trade war is going to see further Purchasing Managers Index falls across the rest of Asia. Okay, so this was this level here was the tariffs on 34 billion worth of Chinese imports, and there was a slight move down, particularly in the Vietnamese manufacturing PMI readings. Then we had the 10% levy on the 200 billion of Chinese goods, and if you take a cross section from here to there, you know, you can see the trend is a gentle slope from the left down to the right. You can see that gentle slope, and obviously the Japanese manufacturing index dropping below 50 for the first time, so that's a concern. Quick recap for those of you who aren't aware that the China and US account for around 40% of the entire world's GDP. So obviously a Chinese war and a US trade war is going to affect the whole globe, the whole economy. And, you know, Australia's GDP, 30% of that 1.81% comes from its deal and its trading with China. So, you know, that does help put it into context. Brexit, big week for the Brexit. Theresa May is making a statement now as we speak in Sharm el-Sheikh, and she's saying that there's no majority in UK Parliament for any options. EU's Tusk says after summit. So EU's Tusk is concerned about there not being a UK Parliament majority. Tusk is also saying that the closer we get to 29th of March, the more likely an extension becomes. Okay, that's interesting. EU's Juncker saying we're making good progress. EU's Tusk says whatever the scenario, the EU 27 will show maximum goodwill. These are headlines coming out on Reuters right now as we're live on this webinar. So Theresa May is making a statement at 1 o'clock, and she's going to make a statement in UK Parliament around 2 o'clock to 3 o'clock. That's GMT time as well. So very significant times for Brexit. Just want to show you what's going on here, because there's a few different dates. So on the 12th of March, UK Parliament are due to get a final vote on Brexit. Okay, so that is coming up in a couple of weeks' time, 12th of March. Now, there has been some talk about potential delay past the 29th of March deadline. And if it goes past that 29th of March deadline, some people have been talking in the UK about having like a 3-month extension. Okay. Now, I was reading on Bloomberg over the weekend, just preparing for this webinar, and I saw that there was a Bloomberg article, and it was stating that the EU thought that a 3-month extension was too short and was mooting a 2021 extension. Okay, so that is, we're now in 2019, 2020. So that's nearly 2 years. So that it's politically, you think about it, if Brexit is delayed, the longer it's delayed, the less likely it is that it's actually going to happen. Okay. So that's the concern of some within the UK, is that, well, if it gets delayed for nearly 2 years, then it may not happen. That in itself could create a lot of volatility for the pound, and also short-term an extension for the pound would be good news. But then quite quickly, An extension of only 3 months will just mean that's more uncertainty, less businesses can make decisions. It's going to continue to weigh on the pound if there is that extension. So typically what you expect is a sudden spike in the pound on the news, and then a selling off as traders reflect and accept that this extension is probably not going to be good news. The Brexit situation is very difficult. This sums it up completely. Britain keeps trying to put, a 3-socket plug into a 2-socket plug. It's a UK power source into a European Union power supply, and you can see that it's just not going to happen. And that's essentially what Theresa May keeps trying to do. She goes over the same ground, the same deal, hoping that the EU will change. They're not likely to change, and particularly if they're having a delay of 2 years, then it plays into their hands that Britain hasn't left the European Union, which is of course what they would want to happen, and to have this whole situation reversed. So just to be aware of that, but significant, don't miss these ones. Theresa May speaking Sharm el-Sheikh today, and Theresa May making a statement in UK Parliament around 2 to 3 o'clock. Okay, so now let's start looking at the FX week ahead. We have some good. First of all, we had data out last night, which was New Zealand data. The 4-quarter retail sales were up 1.7%. They were helped by some pharmaceutical and consumer beverage sales data. So that's a good result there. It's the highest retail sales data since June 2017. So that's some good news out for the New Zealand dollar. We then also had, looking ahead, what we have the next significant thing, looking at the calendar. We've got Mark Carney speaking, not particularly market moving. That was today. It's just going over the same ground, waiting for Brexit to end. We have the inflation report hearings, and Theresa May speaking. I said it hasn't got the time on the calendar here, but that's going to be around, well, let's just have a look what time it is. It's going to be around 2 to 3 o'clock. That can drift that number. So just be aware of that. That is happening tomorrow. We also have Fed's Chair Powell testifying around 2 o'clock GMT. Now that is really helpful because the US is in an interesting position at the moment, because the US-China trade war is going to be weighing potentially on the US economy, and the concern has been that the US economy is slowing down, but then there've been some really positive signs in the US economy. What's made it more complicated, as the markets try to assess how the US economy is doing, is we had those 30+ days of US government shutdown. So that affected a lot of data agencies who haven't been able to put out the relevant data. So now we're starting to get a final, a little bit of understanding about how the US economy is doing. The recent days of delayed December retails data, now they came in below expectations, and durable good orders also disappointed. We had market February's manufacturing flash PMI, which was unaffected by the shutdown and was a different situation. But Jerome Powell is going to give his take on the economic outlook on the February 26th and 27th. Okay. So what the market is going to be looking at with the next flurry of US data that's coming out this week is going to be like, well, how is the US economy doing? And the market's going to be looking at all the economy, all the data. We've got capital order goods. We've got Jerome Powell speaking over a couple of days, pending home sales, some factory orders. We have on the Friday, we have the another speech from Fed. We have on the, sorry, I think I said Friday. Yeah, it's a Thursday. Sorry about that. You've got Jerome Powell speaking again on the Thursday. And this is the one to look out for. We've got the GDP data. Okay, the GDP data is forecast to be 2.4%, which is obviously down on the 3.4% previously, but 2.4% is still pretty good. So the market's really looking at this GDP number in particular, just to try to get a handle on how the US economy is doing. And the market's going to start to be thinking, well, is the Federal Reserve going to continue on their pausing of rate hikes, or if the economy really starts to show an unexpected boost, it's going to raise question marks over that analysis. So that's just to be aware of for the US coming in this week. The data is being viewed carefully just to see how things are going in the US market. Now, again, with the EU, we have the big picture with the European Central Bank is the slowdown that has been. If you have a look here, you can see that the ECB kept saying that there's been temporary factors slowing down the EU's growth. You know, is it French protesters with the yellow vests, new car maker legislations, Brexit risks, China risks weigh on sentiment, and you know they kept saying temporary. However, so the slowdown has carried on into this first quarter, and the data that's going to be particularly interesting is going to be on Friday. And that is a number of PMIs that are coming out across Friday. Let's just get to Friday, Thursday, Friday. Where's Friday gone? Yeah, that's Friday. So we're going to see a number of PMIs coming out of the Eurozone. So we've got Germany market manufacturing PMI. We've got the Eurozone market manufacturing PMI. We've got Spain's market manufacturing PMI. We've got France's market manufacturing PMI. We also have Italy's market manufacturing PMI. So a lot of these PMIs are coming out on Friday. And so the market's going to be looking into that and saying, well, is that slowdown growth carrying on? So we're going to be looking into February's PMI surveys, and it's going to indicate probably that factories across the block shunted into reverse for the first time in 6 years. So if you look at the PMIs, that's 52 versus 52.8 for the UK. We are expecting, we haven't got any data there for Germany. We have got, what do we got here for Spain? Yeah, as these, the thing to look at is to look for these anticipated readings. And when we see the anticipated readings of the PMIs coming out, that gives us a good indication that that's going to be a negative for the euro. So going into Friday's meeting, just have a look at the PMIs. It's not very clear on this this calendar, but have a look around. Just do a Google search for you know, PMIs on Friday, March the 1st. Forex Factory can be quite good because you can use a filter to filter down the euro, only the euro pairs. Yeah, let's see. We can filter down. Can we filter down Europe here? Yeah. You can have a fiddle and see if you can just filter down the European pairs, and that slowdown. So the ECB is going to think, well, is that growth carrying on? Because at the moment, the situation for the European Central Bank is they're saying, yeah, the market's read us correctly about one rate hike in the summer of 2019. Okay, if that slowdown keeps carrying on, then that situation is going to be reversed. So be aware of that for trading the euro, particularly into Friday. So that's one that's potentially a sell, you know, a sell the rumor, buy the fact kind of trade going into Friday. And for those of you who are familiar with that on the workshops, you'll know what I mean. So that's Friday's PMIs. Look out for that. The inflation at the moment is 1.4 for the Eurozone. The lower that gets, the less likely the ECB are going to raise interest rates. There's their inflation target right up here at 2. It's 1.4%, lowest since 2016. So if that carries on dropping low, then the chances of the ECB raising interest rates are less likely. So growth, inflation, remember, they're the two most important factors looking at a central bank's data that it has to assess. So the manufacturing PMIs push into those data. One trade we've been looking at over this month, since the start of the month, is February. We've seen a really good month for oil seasonally, particularly February. It's rising 15 out of the last 20 Februaries since 1999. It's a very seasonal trade. Oil, you can see it tends to fall in value at the end of the year, tends to pick up in value at the start of the year. So that's something to be aware of. The oil charts has been very good as of late. I'll just show you the oil trade that we were looking at, and you'll see with this oil trade, it was a trade we flagged up on our workshop. And if you just see here, you can see that see from the start of February here, you can see that prices increased. We looked here at a good pivot point. There's a lovely pivot point here, which was a good entry. It was a false break of an inside bar, and I kept one position open from this level, and I was trading up to the 60 handle. Although I have taken profit now, you can see that price moved up into this resistance 1 level and started selling off. Now, the reason it started selling off was what caused me to close the trade today, and it was this Trump by tweet. Donald Trump saying oil price is getting too high. OPEC, please relax and take it easy. World cannot take a price hike. Price hike fragile. So I saw that and I just thought, Donald Trump talking about oil prices. I've taken a good a lot of profit on that trade, a lot of points, a lot of pips. Let's take my profit and close out on that. But then don't forget the following March and April are potentially good months as well. So there's potentially more good seasonal months, but of course you want to combine it with a fundamental reason to trade as well as just the seasonals. And again, remember the US dollar CAD and oil correlation, they're 96% correlated. So if you're trading US dollar CAD, you need to know what's going on with the oil charts as well. Okay, guys, well, thank you very much for being with us. You can see it's a really big week coming up. Don't forget the special offer we have is that if you deposit these different amounts, you get an hour coaching session with me. Deposit $3,000 and you get an hour coaching session and an hour's follow-up review, also resolving personal trading queries. Also deposit $10,000, you get the 2-hour coaching session, 1 hour trading follow-up review, and 1 week's VIP support from myself. So they're the offers that we have going on at the moment at HYCM. So if you haven't deposited any money in the account and you're looking to a deposit account, don't forget this offer, because it's a good way of getting some extra support and help as you start your trading journey. Thank you very much. I just want to say that we will be here tomorrow at 1 o'clock to 2 o'clock GMT doing a workshop. We'll be looking at putting some of the basic trading principles into practice so that we can see how to detect which currency pairs are the best ones for trading on any given day. I hope you have a good day. Thank you very much for attending HYCM's webinar, and I look forward to seeing some of you tomorrow and some of you again next week. Take care and have a good week. Thank you, Raj. Thank you, Nadir. Good to see you guys. Take care now. Goodbye.